Ntatendenza igice. Kwiga rwose kuri zo mu biragoye.
Biragoye. Ndabona lecture yaje.
Yaje. Good afternoon, Director Charles.
Ego.
Evening. It's
How are you?
Yeah.
Good evening.
Evening. We'll be starting at
Yes, we are starting with Lease.
Pardon?
We are starting with Lease.
Yes.
Have you heard, sir?
Yes, Andrew.
Have you heard what Joseph has said?
Yes.
They have been missing you.
Thanks for missing me.
I think Joseph is hearing.
Joseph, what are you saying?
Yes. I'm saying,
yes,
we are happy to receive you again.
Thank you so much. So let's just wait for in 4 minutes time we are starting. We had agreed at 6:15. Let us hope most of us are preparing to start to join.
bari kunywa none mukanya ni mumvise Silas ariko ngo bite pasteur yari ari kuzamuka ari nk'aya haraguru.
Viñas.
Erega abanyamwana ubu natangiye amasomo.
Numve ko neza nyumva mwana n'uwo ufiteho amayinite terasi mbare mbaza
Igomba kubaho. Igomba kubaho. Ibyo ukuramo nyine ukashyira hariya.
batanyumva.
So I've just muted all of us so that we start in a quiet environment. Again, in an evening, I really always don't want to take much time. Once we finish the standard, we just wait for the next class. So today I wanted us to cover a standard called IFRS 16. So maybe let me go back to the first slide. So we are looking at IFRS 16. IFRS 16 basically talks of leases. Now, in this standard, previously, this standard was called IAS 17. Previously, the standard was called IAS 17. Later on, I'll explain to you the changes that were made when it was being changed to IFRS 16. What changes were made so that we move from IAS 17 to IFRS 16. That is basically what we'll be looking at. Now, in order to start us off, remember IFRS 16 talks about leases. I'll try to avoid a lot of writing. I'll only write when solving questions so that we move fast and we meet the objective as soon as possible. Now, previously, we have said the standard was called IAS 16. Now, in IAS 17, sorry, not 16. 16 is PPE. IAS 17 was leases, but it is now called IFRS 16. Now, what is a lease? A lease is just a contract. A contract is an agreement between two parties, two or more parties. So a lease is a contract. So the key word there, a lease is a contract or part of a contract on cause that conveys the right to use an asset. In other words, it gives the right to use an asset for a period of time in exchange for some amount of money. So what is a lease? A lease is just a contract that gives a right to use an asset, not permanently. When we get into a contract with you to use your asset permanently, that is not a lease, that is buying an asset. So a lease is a contract or part of a contract that conveys a right to use an asset. So if I give you a right to use my motor vehicle for maybe 5 years at some agreed amount, maybe per year or per month, that becomes a lease. So what are the key characteristics of a lease? Number one, it must be a contract. Number two, there must be an asset involved. There must be an asset involved, and there must be a transfer of a right to use an asset. And there must be some money involved. Now, in a lease, there are two parties involved. A contract normally has got two or more parties. In a lease, there are two parties involved in signing of this contract. There is the person who issues the asset. The person who gives the asset is called a lessor, or whatever you pronounce it. So the person who gives the asset in that contract is called a lessor. And there is the person who receives and uses the asset is called a leasee. So ensure you understand that the person giving out the asset, the seller in quotes, the person giving out the asset is called a lessor, and there is the person who receives the asset, the user of the asset is called a leasee. Okay. Now, what is the objective of IFRS 16? IFRS 16 is basically to prescribe for the lessees. Remember, a lessee is the receiver of the asset, the user of the asset, and the lessors, the issuer of the asset, the appropriate accounting policies and disclosures to apply in relation to, let's just call these in relation to leases. Previously, I'll come to that in relation to leases. So it basically prescribes to the lessee and the lessor the appropriate accounting policies and disclosures to apply in relation to leases. Okay, I said I'll try to be fast in definitions. Now, there are two types of leases, but basically the difference between these leases is more of under IAS 17 than under IFRS 16. The difference in definitions is explained in IAS 17. IAS 17 is still leases, but previously, before it was changed into IFRS 16. So in IAS 17, the previous standard, which was called still leases, it clearly defines what is an operating lease and what is a finance lease. So there are two types of leases. I will explain to you where IFRS 16 comes in relation to this. So there are two types of leases. There is what we call finance lease, and there is what we call operating lease. Remember, in a lease, there is the lessor and there is the leasee. Lessor transfers an asset to the leasee in order for the leasee to use the asset at some consideration. Now, what is a finance lease? When we talk of, there are two types of leases, don't forget about that, either finance or operating. What is a finance lease? A finance lease, it occurs when you transfer risks and rewards related to ownership to the leasee. So a finance lease arises when the owner is called the lessor. It transfers all the risks and rewards related, incidental means related to ownership to the lessee, the user. So when there is evidence that risks are all the costs associated with the asset. Rewards are all the benefits associated with the asset. When there is an evidence that risks and rewards have been transferred, we call that finance lease. Now, when there is no evidence that risks and rewards have been transferred, it will be an operating lease. I'm repeating. In operating, there is no what? There is no transfer. In finance, there is what? Transfer. So where there is a transfer of risks and rewards to the lessee, to the buyer in quotes, it is a finance lease. Where there is no transfer of risk and rewards, it is an operating lease. I will come back to that. Now, I know the question is, what are the risks that are being transferred and what are the rewards? Now, risks are all the costs associated.
And also incidental.
Pardon?
Also incidental. Also incidental.
I'm not getting you.
Risk and reward incidental.
Yes, the word incidental, I've said related.
I'm
You
saying,
can use the word related.
reward. Ah, okay.
Are we together? So I'm avoiding using, the word that the standard uses. I'm quoting for you the standard directly, but I'm trying to explain in simpler words. Incidental is related. So where there is the word incidental, put there what? Related. Are we together? So in finance lease, this is where the owner transfers what? Risks and rewards related to ownership to the leasee. Are we together? The person who was seeking
Yes.
clarification. Can I now move on? I was talking of
Yes.
risk. What are some of the examples of the risk that we are talking of here? An example of the risk is depreciation. If it is the leasee, the receiver of the asset, that is charging depreciation, depreciation is a cost. That is a risk. So if it is the receiver we have said is called who? Leasee. The giver of the asset is called the lessor. So if it is the receiver of the asset charging depreciation on the asset, in that case, it is a finance lease. But if it is the original owner charging depreciation, in that case, it is operating lease. So an example of a risk is depreciation. Another example, maintenance of the asset. Maybe some repairs and maintenance on the vehicle. So if it is the receiver of the asset, the leasee, who is maintaining the vehicle, maintaining the asset, it becomes a finance lease. But if it is the owner, the original owner, who is maintaining the asset, it becomes what? Operating lease. I'm still in finance. Now, rewards are all benefits associated with the asset. If it is a leasee who is receiving the benefits, maybe he's using the vehicle as a taxi and it is generating for him some income. In that case, he's receiving all the rewards. In that case, it is a finance lease. But if the leasee is not currently receiving any reward, it becomes an operating lease. However, I must say, the definition is under IAS 17, under the old standard. Now, the question is, how do you know in a question that risks and rewards have been transferred? You know, it is very easy to say risk and rewards have been transferred, but it is difficult to identify that risk and rewards have been transferred. How do you know the risk and rewards have been transferred so that it becomes finance lease? There are a number of points. There are around 8 points which you look for in order to know there is a transfer of risk and rewards. I'm repeating. Qualification for being a finance lease. How do you know that an asset is qualified to be a finance lease? I'm still in IAS 16, and then later on I'll relate it to IFRS 16. I'm still in IAS 17. Later on I'll relate it to IFRS 16. Okay, so how do you know an asset meets the conditions for finance lease? If any of these 8 conditions, any, which means one of the 8 conditions have been met. What are the conditions? Number 1, if there is evidence that the lessor, the owner, will transfer the ownership of the asset at the end of the lease period. Maybe we leased a house for 10 years, and there is an agreement in the contract that after 10 years, the person leasing will receive the asset permanently. In that case, we say the lessor will transfer the ownership of the asset at the end of the lease what? Period. So when the lease period is over, the leasee will receive the asset. In that case, it is a finance lease. The second condition, I hope you've understood the first condition. If there is evidence that at the end of the lease period, the asset will be transferred to the leasee, in that case, it's a finance lease. Condition number 2, remember I said any of the 8 conditions. Condition number 2, the leasee has an option to purchase the asset at the end of the lease period, which means we are leasing the asset for maybe 10 years. Let me use 10 years as an example throughout. So we are releasing the asset for 10 years, but in the contract, there is a clause that says that at the end of 10 years, the lessee can opt to buy the asset permanently. And the amount that we will pay to buy the asset permanently at the end of the lease period, this amount is less than the fair value of the asset at that time. The amount you will pay is less than, it is very less than the fair value of the asset, the market value of the asset at that time. So if there is a condition that we can buy, when I say we are talking of the lessee, we are talking of the business. If there is evidence that the business can buy the asset at the end of the lease period, in that case, it becomes what? Finance lease. And when you are buying it, you will pay a very small, insignificant amount. Point number 3. The lease term is for a major part of the economic life of the asset, even if it is not transferred. For example, if the life of the asset is 10 years and we have leased the asset for 9 years, what does that mean? We have leased the asset for almost equivalent to the life of the asset, or equivalent to the life of the asset. So if the lifespan of the asset is 10 years and we have leased the asset for maybe 9 or 10 years, in that case, the lease period is very close to the lifespan of the asset. It becomes finance lease. So if the lease period is close to the life or equal to the life of the asset, in that case, it becomes finance lease. The next point, the discounted minimum lease payment is greater than or equal to the fair value of the asset. I know there is a question there. Now, suppose I'm leasing a motor vehicle. Maybe the cost of the motor vehicle is 10 million. The cost will be the fair value, the current market price of the motor vehicle. If I was to buy it cash, I will pay 10 million. The 10 million in that case will be the cost of the asset or the fair value. But I know in IAS 16, there is a difference between the cost and fair value. I know in IAS 16, there is a difference. But now I'm saying if we bought the asset cash, we didn't lease, we could have paid maybe 10 million. Now, when you lease and what you end up paying at the end of the lease period, if the lease period is 10 years and you lease the asset and the amount you end up paying every year, when you add it for 10 years and you discount it, it is more than the cost of the asset. In other words, the rentals that you pay, these rentals that you pay, when you cumulate them, when you add them, they become what is called what? Minimum lease payments. Maybe for the lease, maybe every year we are paying an amount of maybe we are paying 1.2 million every year for 10 years. At the end of the 10 years, we will end up paying 12 million. So if at the end of the 10 years, we were paying every year 1.2 million. After 10 years, it will be 12 million. Yet the cost of the asset was how much? 10 million. So if that is the case, it becomes a finance lease. Now this 1.2 million every year for 10 years becomes what is called what? Minimum lease payment. When you discount it, to discount is to get the present value. It becomes what is called discounted minimum lease payment. Now, what are the 4 conditions before I move to the last 4 conditions? Number 1, at the end of the lifespan of the asset of the lease period, the asset will be transferred. Number 2, the lessee has the option to purchase the asset at the end of the lease period at a price that is significantly lower than the fair value. Number 3, the lease term is for a period that is close to or equal to the lifespan of the asset. And number 4, the minimum lease payment is greater than or equal to the fair value of the asset. Well, yes? Okay, let us move on. You know, it's an evening.
Okay.
Yeah?
I have a question, sir, about the fourth point. I didn't catch it well.
Fourth point.
Do we...
Okay, fourth point.
Yeah.
Ignore for now. Ignore these. Ignore these. Ignore. I'm trying to look for a canceling sign. Okay, I cannot. So ignore the discounting. But I hope you know how to discount. You know how to calculate the present value. Do you agree? In value in use under IAS 36. Yeah, IAS 36 was impairment of assets, if I'm not wrong. We looked at how to discount when we were calculating the value in use. Now, what we are saying in a lease, you are not acquiring the asset permanently. Maybe you are acquiring the asset by renting. Maybe you are renting the asset for 10 years. Do you understand me? So this amount of rent that you are paying for 10 years, if you add the amount you are paying every year and you add it for 10 years, if it is more than the cost of the asset, in that case, it becomes a finance lease. Have you understood?
So, So meaning that this word, the discounted, is not, you should not consider it?
No, you consider it. I'm just removing it so that you understand. I'm removing it so that you understand. Are we together?
We understand.
Okay. So let's go to the point number 5. In case of cancellation of the contract, you know, sometimes you get into a contract with somebody and then you cancel the contract. Do you agree? In case of cancellation of the contract, if the party that cancels the contract bears the losses of cancellation, it becomes a finance lease. Let me explain using other words. You know, a contract is an agreement. And once you get into a contract, you must honor the agreement. Now, in case me as the leasee or the lessor, one of the parties cancels the contract. If the party that cancels the contract meets the losses as a result of cancellation of the contract, maybe you hired a lawyer to help you in the court cases, etc., in the process of canceling the contract. If the party...
Excuse me.
Yes?
There's something I don't understand when they point to one.
Point one.
Yes, you said that the leaser, will transfer the ownership to the lease at the end of the lease period. And the point 2, you say the lease has an option.
Okay, I've understood you. These points are independent of each other. I started by saying you check on any of the conditions. If any of the conditions have been met. Have you understood me?
Go on. Yes, I'm understanding you.
So point 1 is totally different from point 2.
Yeah.
So if point 1 is not there, you check for point 2. If point 1 and 2 are not there, you check for point 3. They are independent of each other. They are not related. That is why I've said you check for any of the conditions, not all, any of the conditions. Are we together?
Okay.
Okay.
Yes.
Let us continue. Now, next, in case of cancellation of the lease agreement, the party which cancels the agreement bears the what? Losses. So if there is cancellation of the lease agreement, the person who cancels bears all the costs associated with cancellation. It becomes next, the asset is of a specialized nature, and only the lessee can use the asset without major modification. So sometimes the asset is a very special asset that if it was to be sold to another person, there will be a lot of modifications. So if it is of a specialized nature that only one person can use it, but if you transfer it to another person, the other person can what? Can do a lot of changes. It becomes a finance lease. Kovia, you have a question?
Yes. Yes, I was asking on point 5.
Yes.
Where you were saying that the cancellation of the lease, that means when it's specified in the contract that when they cancel the lease, the person who canceled it is the one that will bear the loss. All you wait upon the cancellation of the contract.
No, when it is stated in the contract that the party that cancels, you know, what is to cancel a contract? If there is a lease period of 10 years, what is to cancel is to dishonor the contract before the 10 years ends. You know, when I get into a lease contract with you for 10 years, I'm the one who should be using your asset for 10 years. But in case I cancel the contract in the 6th year out of 10 years, I've gone against the, let me just mute. So I've gone against the contract. So if I go against the contract agreement, I've canceled the contract. So if I'm the one who cancels the contract, and in the contract, it is stated that if you cancel the contract, the person who cancels the contract is the person who meets the cost of cancellation. You know, any party can cancel the contract. Maybe the owner can cancel the contract, or the leasee can cancel the contract. If there is a statement somewhere in the contract that the party who cancels the contract meets the cost of what? Cancellation. Scovia, have I answered you? Let us move.
Yes.
Okay, let us move to point.
Excuse me.
Yes.
Excuse me, lecturer.
Yes, Joseph.
If, for example, let's assume that the owner is the one who canceled the contract, and maybe he has been receiving the lease repayment by the lessee. So in that case, if the owner is the one who initiates the cancellation, we return that lease payment to the lessee.
No.
That is number one. Question number two. Question number two, how do they judge that the lessee is the only one who can use that specialized asset? In the market, there are many specialized partners or individuals who can use the asset without modification. How do they say that there is?
Okay.
Yes.
Now, there is no refund when one party cancels the contract. You know, lease is paid on every year, rentals. So by the time you cancel the contract, maybe I've paid rent for the first year, second year, third year. Maybe you cancel the contract at the end of the third year. I've already paid rent for first year, second year, third year. So there is no problem. The contract is canceled, but it's just that the future payments will not be made. But the payments that are past have already been done. Past payments have already been done. So those ones are not refunded. Now, your second question, let me give an example. I don't know very many buildings, but let's think of, I'm renting a house, and that house, it is a hospital. I'm renting it so that it becomes what? A hospital, which means somebody, maybe you, okay, I've forgotten your name. Maybe Andrew has constructed a hospital. He has constructed a hospital, but he doesn't run the hospital. He leases the hospital to Charles, the lecturer Charles. So Charles is the user of the hospital. Now, when there is a change in the lease, maybe the new tenant is not interested in a hospital. There will be a lot of modifications being done so that we convert that into a school maybe. Maybe the new tenant, he wants to have it as a school. There will be a lot of modifications done. Do you understand me? In case that, we say that asset is of a specialized nature, and a lot of partitioning and repartitioning will be done for it to be changed. I hope I've explained that. So in that, but if the contract is cancelled and there is no change being done, you can just rent it to any other person. In that case, it is not of a specialized nature. Number, allow me to move on, please. I'm seeing we have already taken 30 minutes. So gains or losses from fluctuations of the fair value are borne by the lessee. If there is any change in the fair value of the asset and there are gains or losses as a result of the change in the value of the asset, and these gains or losses are covered by the lessee. Remember, the lessee is the tenant, the user of the asset. The lessor is the owner, the giver of the asset. So if it is the lessee, the tenant, who gains or loses from fluctuations in fair value and use of the asset, in that case, it is what? A finance lease. In other words, the person who is leasing the asset, maybe you are the lessee, you are the user of the hospital. If you will gain from increase in the value of the asset or loss in the value of the asset, in that case, it becomes a finance lease. And lastly, the lessee has the ability to continue the lease for a secondary period of time at a rent below the market value. What do we mean by this? The lease was for maybe 8 years, and the life of the asset was 10 years. So at the end of the 8 years, if the lessee has an option to continue renting for an additional period of time at a price that is significantly low compared to what you were paying previously, it becomes a finance lease. Now, if any of those 8 conditions, the first 4 and the last 4, if any of those conditions are not met, any, I've not said all, I've said any of the conditions are not met, it becomes operating lease. If any of the conditions are not met, it becomes what? Operating lease. If any of the conditions are met, it is a finance lease. If any of the conditions are not met, it is an operating lease. Now, please listen to me carefully. The examiner, moving forward, is really not interested in the conditions, because the reason why previously we were interested in the conditions is because accounting treatment of finance lease and accounting treatment of operating lease was different. It was different under IAS 17. Accounting treatment was what? Different. But under Ifrs 16, the new standard, leases, they all talk of leases, accounting treatment is the same. So whether it is operating or finance, the accounting treatment is the same. Okay. Now we were talking of...
Excuse me, sir.
Yes.
I didn't get well the number 6, where the specialized in nature. It means that these modifications were done by the lessee or the...
No. It doesn't mean that. It means that, you see, let us read it once so that you understand. The asset is of a specialized nature, and only the lessee who can use the asset without what? Major modification. So which means if there is a change in usage, you know, lessee is the tenant, the person who rents, lessee. Now, yes, if there is the change of the tenant, the person who is renting has changed, and there is modification to be done before the new tenant comes in, it becomes finance lease. But if there is no major modification, it becomes what? Operating lease. Have you understood me?
Not well. Meanwhile, if there is a modification that would be done before the tenant get in. And at that time, it is the finance. The finance.
Remember, a lot modification can be done. Modification must be done, but we are saying major modification, major transformation. So if there is a lot of modification to be done, it is an operating lease. Sorry. Sorry. If there is major modification, it is a finance lease. If there is no major modification, it is an operating lease. Am I clear?
Excuse me, can you illustrate it with an example to make it clear and understandable?
I had already illustrated with an example, Ange. I said, if you are renting a hospital, I gave an example of Andrew. If Andrew constructs a hospital to rent it out, to lease it out, a hospital is a specialized asset, is a specialized building. Now, if the renting of the asset will change from a hospital to a school in future, remember when you are changing from a hospital to a school, there is a lot of modifications to be done. Do you agree? We must change those wards, those theater rooms into classrooms. There is a lot of modifications to be done. In that case, it is a finance lease because there is a lot of modification to be done. In that case, we say the asset is of a specialized nature and it can only be used as a hospital unless a lot of modifications are done. Ange, are we together? Okay, let me hope we are together. So, can you allow me to continue? There is a
I'm still.
Yes?
I'm still asking it. We don't consider who made the modifications. It can be the lessor or the lessee in that case. We consider
no, we don't look at who did the modification. So long as modification is done, so long as major modification is done, we don't care the party that does the modification.
Okay, thank you.
Now, you know, there is what we call hire purchase. Let me use the hire purchase. I'm not saying hire purchase is lease. They are not the same. You know what is hire purchase? Where you go to a store in Mumuji, you want to buy an asset. You want to buy an asset, maybe a car. You want to buy a car, but you don't have enough cash. So you pay the car in installments. Are we together? The seller gets into an agreement with you that I don't have this 10 million. But because I don't have the cash price of the car is 10 million. But now you get into an agreement with the seller that instead of paying you this 10 million, which I don't have, why don't I get into an agreement with you that I use this asset for 10 years? And for the 10 years, okay, a car, maybe let's talk of 5 years. Maybe for the 5 years, I'll be paying you some rent per year. Now, normally, when you pay this rent per year, at the end of the life of the asset, it ends up being more expensive than the cost of the asset. Do you agree? I'm repeating.
Yes.
Do you agree with me?
Yes.
When instead of buying at once, when you buy in installments and just pay rents every time for maybe 5 years, it ends up being more expensive. Now, if you are in agreement with me and you understand that, that is the basis of IFRS 16. It is the first calculation that will be done in IFRS what? 16. We need to get the difference between the cost of the asset and these cumulated rentals that you pay every year. When you cumulate it, year 1, I paid 2,000. Year 2, I paid 2,000. Year 3, I paid 2,000. If you cumulate these, and then you get the difference between this cumulated and the cost of the asset. This difference is called a finance charge. So it's called a finance charge. So how do we calculate it? Finance charge is minimum lease payments. What are minimum lease payments? The rentals that you pay every year. The rentals every year times the number of years. You less what? Cost of the asset. The difference is what is called what? Finance charge. Now the point in leases, the major point in leases, how do we account for this finance charge? That is the major question in leases. Okay. Joseph, you have a question right now, and Laurian, you have a question? Or you had raised your hand?
No. Yes, I have a small question.
Yes.
My question is, I understand financial risk, but I have some question on operating risk.
Yes.
Operating risk is different from rent, original rent. For example, we rent the house, any rent. The rent and operating risk, are there difference?
Yes, they are different. You know,
which ones?
Now you see, renting, when you, maybe the house you are staying in, you have rented. That is not a lease. That is just a landlord-tenant agreement. A lease you must get into an agreement that I will use this asset for a specific period of time. And I'll pay you rent for a specific period of time. For example, I will pay you rent for the next 5 years. In that case, it is a lease. But a normal landlord-tenant relationship is where you just get into an agreement that I will stay in your house. But there is no clause that says for how long. Have I answered you the difference?
Yes, no specification.
No specification of the period of renting. That is not a lease. A lease must be very clear of the period.
Yes. Okay. Thank you.
Now.
Excuse me, lecturer.
Yes.
I have one question.
Yes.
Suppose if the cost of asset.
What is your name?
Is more than minimum. My name is David. If the cost of asset is more than the minimum lease payment, what is it called?
If the cost of the asset is more than
minimum lease payment,
it is an operating lease.
No. You said that the difference between the minimum lease payment and the cost is these charges.
No. I said finance charge. Finance charge.
Oh yes, finance charge. When the cost is more than the minimum lease payment, what does it call?
No. That can never arise. Why? It can never be the case. Reason being, why do we get into lease agreements? The owner of the house cannot rent the house if what you will pay at the end of the day will be less than the cost of the house. No. Business is not done that way. Do you understand me?
Okay.
It can never, the rentals can never be less than what? Can never be less than? Can never be less than the cost.
Thank you.
Okay. Now, if I take all your questions, we will not finish the standard. Can I move on, please?
Yes.
You know, I must also regulate the questions. Remember the class? The class has how many students? 125.
13.
No. The total expected today are 125. It is just that 113 are the ones there. Now, if I take a question from each of the 113, we will not finish. Do you agree?
Yes.
Okay. So let's continue, please. Now,
Limit questions.
Please, let's understand this. The first calculation we are meeting is the rents you pay. When you pay rent per year times the number of years, or rent per month times the number of months times the number of years. When you add all these amounts of rents that you pay for the number of years for the lease period, it becomes what is called minimum lease. Let me say this. Calculations of leases are very easy if you understand how to account for finance charge. So your objective is to ensure you know how to account for finance charge. Now, suppose the minimum lease payment is 6 million and the cost of the asset is 5 million. What is the finance charge? 1 million. Do you agree?
Yes.
Now, this 1 million, how can we account for it in our books? How do we account for it in our books? You should take 1 million, that is the cost of leasing. What is the cost of leasing? The cost of leasing is not the amount you paid. It is not the cost of the asset. The cost of leasing is the extra amount you pay over the cost. Let's talk of a loan. What is the cost of a loan? The cost of a loan is not the principal amount. What is the cost of a loan? The interest you pay on the loan. So take that in leases. Take this to be the interest. Now the question I'm asking you, how do we account for interest? There are 3 ways of accounting for the interest, but the examiner normally asks for only 1 way because the other 2 ways are very easy. Now this 1 million, how do we account for this 1 million? You need to take the 1 million. The first way to account for it, you take the 1 million, you divide by number of years. So if the lease was for 5 years, you take 1 million, divide by 5 years. So finance charge every year will be how much?
20.
If you take 1 million, divide by 5 years, finance charge will be how much?
200.
200. That method is called straight line method of accounting for finance charge. What is that method called? It is called what? Straight line. There is another method. You take, what was the lease period? The lease period was 5 years. Are we together?
Yes.
You can take 5 years plus going downwards. 5 plus 4 plus 3 plus 2 plus 1. Somebody who is good in maths? You can take 5, if the lease period was 5, you take 5 plus 4 plus 3. I'm going backwards. You add like that. 5 plus 4 plus 3 plus 2 plus 1. What is that total?
15.
15. Now, in the first year, what you charge is the first year, 5 over 15. 5 over 15 times the finance charge amount. The second year, what you charge is 4 over 15. The third year, what you charge is 3 over 15. The fourth year, 4 over 15. That method is not straight line. Straight line, if it is
Some digit.
Thank you. That is financial accounting. I'm going slowly because there are people who are exempted. That is called what? Sum of
digits.
Thank you. You have answered me. The last method was not covered in financial accounting. It is called actuarial method. You know actuarial science, eh? So the last method, and this is the method that the examiner tests. Whether it tells you or it does not tell you to use actuarial, you must use actuarial unless it tells you to use straight line. Now, finance charge is an interest. Interest, where does interest go to? Interest goes where? To the income statement.
Statement and expenses.
Do you agree?
You thought that the second method, we call it.
There are people asking.
One question. Yeah, what the name of the second method?
Sum of digits. I'm coming to it. Look at the screen.
Okay.
Look at the screen. Are you seeing the screen? Sum of the year digits what? Method. Now, what I'm going to say, the most common method that is used is called what? Actuarial. Are we together? Now,
Yes.
as we go to an example, I'm still remaining with 1 hour to cover examples. As we go to examples, the first thing you need to know, when was the rent paid? Please, in any question, the most important thing is to know when the rent was paid. Rent can be paid either at the beginning of the year or at the end of the year. When we pay rent at the beginning of the year, we call it advance.
Yes.
When we pay at the end of the year, we call it arrears. So read any question carefully. You ask yourself, was rent paid in arrears or was it paid in advance? Are we together? And that method, we are only careful under actuarial method. So it can either be in arrears or in advance. Under which method? Actuarial method. Be very careful in the question. Did the question ask you to use actuarial method, or did the question ask you to use what? Sorry, did the question ask you to use arrears, or did the question ask you to use advance? What is advance? When rent is paid at the beginning. What is arrears? When rent is paid at the end. Now, when you go to your notes, there are 2 examples. Are you understanding me? Yes. Now, those 2 examples, I've already solved them in advance, and I will give you the answers. I'm not interested in those examples. I'm interested in past paper questions. Are we together? The examples in the notes, I've already solved them in advance, and I'll share with you the answers which I've already solved. But it is important to look at past paper questions. Now, list down these past paper questions because I'm going to look at them. Just write them down so that I go to Excel sheet and past paper. Just write them down. Take 30 seconds to note down those past paper questions. You know, when we finish these questions, we are very good to go. We are very good to go. Under which method? Under leases. You'll be very okay if you attempt those questions. 30 seconds to list down the questions. Before I leave the slides, I now go to the questions and Excel. I have said in the notes, the examples in the notes, I've already solved them in advance. I will just give you, in the Excel sheet, I will share with you after today's class. In that Excel sheet, example 1 and example 2 are from your notes. Example 3, 4, 5, and 6 are these ones that you are seeing, past paper questions. I hope we are together. Hello, can we now move on? Have you noted down the questions?
Yes.
Okay. Yes. Now, remember, I'm not solving this question. I'm just giving you a scenario. Look at this question. These are the examples in my notes, but they are fairly straightforward. They don't have a lot of, we are not doing them. We are only doing past papers. Now, in any question on leases, they will use very many words. The many words that they use, you should identify the cost of the asset. The second point, you should identify the rent that was paid. Are we together? The third one, you should identify the interest rate. The fourth one, you should identify the period, the lifespan of the asset. And lastly, you should identify, sorry, this is called lease period. This number lease 4 period. Is lease what? Period. Lease period. Lease period. And lastly, you should identify what? The lifespan of the asset. Remember, you may lease the asset for 4 years, but the life of the asset is not 4 years. The life of the asset is maybe 5 years. Are we together? So in any question, whether you know it or you don't know it, number one, what should you look for? Just list this somewhere. Number one, what should you look for? Cost of the asset. Number two, rent that was paid. Number three, interest rate. Number four, lease period. And number five, what? The life of the asset. Are we together?
Yes.
That is what you should look for in any question on leases. Now look at this required. Compute the finance charge, that is requirement number one. And requirement number two, show the extracts of what goes to the income statement and statement of financial position using which method? Actuarial. So whether you have been told or not told, always use actuarial, unless you have been told to use straight line. Now, allow me to go to past paper questions. Allow me to go to past paper questions, and I'll start with June 2014, question 3A and B. This is June 2014. Question, we have said question? I've already closed the slide. It is question?
3A and B.
Question 3.
Question of 3A and B.
Okay, thank you. Now look at this question 3A. Let me read before I go to Excel. According to IAS 17, why is it called IAS 17 leases? Because before 2018, it was being called IAS what? 17. So any question that was set before 2019, before 2019, it is called IAS 17. Any question after 2019, it is called IFRS what? 16. Are we together? So when revising questions, you should revise questions on IAS 17 and IFRS 16 together. According to IAS 17 leases, define a lease and differentiate between finance lease and what? Operating lease. What is a lease? A lease is a contract between two parties. Are we together? Where a contract between two parties for a specific period of time, and there is a consideration being paid. There is an amount of money being paid. So what is a lease? A lease is a contract between two parties. What are the two parties? The leasee and the lessor.
Yes, sir.
For a specific period of time at a certain consideration, at an agreed amount of money. Now, and then next you're being told, and differentiate between a finance lease and an operating lease. Now, it was only 4 marks, and the 4 marks included the definition of a lease. So how do you differentiate a finance lease and operating lease? A finance lease arises where all the risks and rewards incidental. What is the other word for incidental? Related. A finance lease occurs where all the risks and returns incidental to ownership are transferred to the leasee. A finance lease arises in cases where all the risks and rewards incidental to ownership are transferred to who? The leasee. On the other hand, what is an operating lease? Operating lease occurs in cases where all the risks and rewards incidental to ownership are not transferred to the leasee. Are not transferred to the leasee. How many marks? 4 marks. Let us read part B, which is 6 marks. Let us be very careful. What did we say you identify? Somebody to help me. Number 1, cost. Number 2, rent. Number 3, interest rate. Number 4, number of years for the lease. And number 5, useful life. Let's read the question. Bralirwa leased its fleet of delivery vehicles through a finance lease on 1st April 2011. The fair value of the vehicle at the date was 324. This fair value becomes the cost. Because when you buy the vehicle at that date, you will pay how much? 324 million. Are we together? The lease is for 5 years. So you have identified the cost, you have identified the lease period. Can we continue? And payments of 77,700,349 are made every April in what? Advance. So we know that rent is paid in advance. Next, interest rate is what percent? 10%. Show the
10%.
extract of statement of profit or loss and the statement of financial position for the year ended 31st March 2013. Remember, 31st March 2013, understand me, is 2 years from the date of the lease. Is it 2 years?
Yeah.
Do you agree?
Sorry.
Is it 2 years?
3.
You are being asked extract on 31st March 2013. When did the lease start? On 1st April 2011. By 31st March 2013, how many years are those?
2 years. 2 years.
2014, how many years are those?
3 years. 3 years.
So our calculation must be for a minimum of 3 years. But I always advise you, if it is 3 years, do calculation for 4 years or 5 years. I can do calculation for 5 years, but I advise you, if it is 3 years, do calculation for 4 years. If it is 5 years, do calculation for 6 years, etc. Now, I'll give you a chance again to read through Excel. Now, look at this. What I was saying is this. Example 1 in the notes, it is this one. And the workings I've done. Are you seeing the workings?
Yes.
Those are workings needed. I'll repeat the same. Example 2. I just did it before we started the class so that you have very many examples to compare. So there is also that, but that is not the way I teach. I like teaching by doing the questions. Now I have the past paper questions with me there. So we are in which past paper question? This is the question we have read. Are we together?
Yes.
So part A, we have already answered. Let us look at part B. So Brariwa leased. So the first point, what is the question? What is the question asking you? Show the extract of income statement, profit and loss, and statement of financial position for which year? The year ended 31st March 2013 and 2014. There is a lot of calculation. And remember, it is in what? Advance. However, because we are in class, I will teach you both advance and arrears, so that whichever method is asked, you are in a position to do it. Now, the first point, the first working is to calculate the finance charge. How do we calculate finance charge? We said it is minimum. Somebody to help me. It is minimum. Lease payment. Are we together? What is our minimum lease payment? The lease period is how long? Somebody to give me.
4 years.
The lease is for how many years? 5?
5 years.
5 years. Do you agree? Times. What is the rent? What is the rent?
77.
77 million.
700,000.
349. Are we together? That gives you the minimum lease payment.
Yes.
And then we said you come and less what? Cost of the
Cost. Yes, cost.
of the asset. If we acquired the asset, what could we have paid? The difference gives you what? The difference gives you finance what?
Finance charge.
Finance
Charge.
So look at what I'm doing. I'm just expanding this cell so that we get the answer. So what is the minimum lease payment? We have said is equals to 5 times 77,700, 349. So that is the amount. The cost of the asset, somebody to help with the cost of the asset. The cost of the asset is
324 million.
324 million.
324. Now, I hope all of us are in a position to get finance charge. So what will be finance charge? It will be minimum lease payment minus cost of the asset. How much is that?
Yes, that one.
Now, the question is, how do we account for this 64 million? 64 million is the interest we are to pay. Don't use the word interest. I'm just using interest so that I'm seeing attendance is very good. I said I expected around 125. That means you are very good in attending. I advise you, in financial reporting, attendance of class is very, very important. You should realize that by now. Okay, thanks for the good attendance. 121 is a good number. So we are saying in this case, how do we calculate finance charge? Minimum lease payment, time, you have what? Cost of the asset to give you finance charge. But note that this finance charge is for how many years? It is for how many years?
5 years.
5 years. Do you agree with me?
Yes.
Yes.
It is for 5 years. But now, income statement, balance sheet is for every year. Now we need to calculate how much is for every year.
Yeah.
So this 64,501, if we were to use straight line, what will you do? You will take 64 divided by 5 years.
Divided by 5.
If we are to use sum of digits, what will you do? You will take 5 plus 4 plus 3 plus 2 plus 1. First year will be 5 over 15. Second year will times, of course, 64. Second year will be 4 over 15 times 64. But those are the methods not recommended. Which method is recommended? The recommended method is
Actuarial.
Now, before we move on, because we are acquiring an asset through lease, we must also charge depreciation. So when you are charging depreciation, you must calculate depreciation. And the default depreciation method, depreciation of the asset. What is the default depreciation? Depreciation? Straight line is the default method. So you will take the cost of the asset, 24
divided by 5.
Divided by what? 5 years. Thank you so much. So what is our answer for depreciation? 320 000 divide by what? 5. So our depreciation every year, we are in a position to see it there. Are we together? Now,
why not to use the method of actuarial?
No. This is depreciation. This is not finance charge. This is not finance charge. This is depreciation. Are we together?
Yes.
Yes, yes.
Now, your question is very good. You know, it's always good to understand your question. Your question now is the next part. Accounting for rent. Rent can either be paid in advance or in arrears using either actuarial method. So let's use actuarial method. Now, in order to answer this question, please let us be very together here. In actuarial method, we will start with payment of rent in arrears. So payment of rent in what? Arrears. What is arrears? Arrears is when you pay at the end. Do you agree? So you will have a number of columns. Now this is actuarial method. You will have period as your first column. The second column, you will show your opening balance. Opening balance. I will tell you what opening balance is. Don't worry. My work is to explain everything. The next column, you should show your finance charge. Finance charge. I'm just avoiding taking a lot of space. That is why I'm just using the limited space that we have. Finance charge. The next column is what we call outstanding balance. How do you write outstanding? Outstanding balance. Next column is, so let me increase the size of outstanding balance. Next column is what we call rent. Rental. And the last point is what we call closing balance. I hope we are very many. Let us understand this. All of us understand that the difference between arrears and advance is where you account for rent. When you account for rent close to, next to the closing balance, that is arrears method. When I'm repeating, when you account for rent next to closing balance, this is what? Arrears. But when you account for rent after the opening balance, you bring it here, it becomes advance. Have you understood the difference between advance and arrears? Is where
Yes.
now, what is the first column? Period. The next column is opening balance. The third column is finance charge. The fourth column is outstanding balance. The fifth column is rent. The sixth column is closing. Now, when you account for rent next to the closing balance, that becomes which method?
Arrears.
Now, let me copy the same. I'm just trying to be slow so that we understand this semester. We understand this. Here, now let me come and put it there. Sorry. Let me come and put it there. Okay. Now, this is now advance. So let me change this to advance. Advance. Now, in advance, somebody to help me. What did I say in advance? Finance charge goes where rent was, and rent comes where finance charge is. Are we together? So here we have what? Rent. When it is posted next to the opening balance, it is advance. And then here we have what? Finance charge. I hope you understand the difference between arrears and advance. Advance, rent comes next to opening balance. In arrears, what happens? In arrears, rent comes next to closing balance. I think I've explained everything there. 1, 2, 3, 4, 5, 6. I'm just trying to create more columns. So periods. How many years do we have? How many years do we have?
5 years. 5 years.
Year 1, year 2, year 3, year 4, year 5. Okay. Now, what is the opening balance? You pick the cost. The cost is the opening balance. So what is our cost? Our opening balance was how much?
324 million.
Yes. 320. So let's get 324 million.
4,000
million.
Do you agree with me?
Yes.
Yes.
Okay, let me put commas so that everyone can see the figure clearly. Finance charge. You take this percentage given here. Do you see this percentage given here? The interest rate is what percent? 10%. 10%. Are we together? So you calculate 10% opening balance. Percent of what? Opening balance. So it will be times what? 10.1. So what do we have?
400.
32 million.
You agree with me?
Yes.
Outstanding balance is opening plus finance charge.
My finance charge.
Are we together? Outstanding is opening plus finance. So what is it?
Sir.
This.
Hello.
Yes.
if there they say implicit, the interest rate implicit in the lease, maybe that another day you can say explicit. Maybe.
No. Implicit means related. Implicit means related to the lease. The interest rate related to the lease. Implicit means what? Related. Are we together? Or can be attributed to the lease. Are we together? They cannot use explicit. No, they cannot use explicit. That is just an English word that they used. Okay, rent. How much was the rent?
77.
77. 700, 349. Do you agree with me?
Yes.
Okay. Now, closing balance is, understand me, outstanding minus rent. Are we together?
Yes.
Outstanding minus rent.
Rent.
What will it be? It will be outstanding minus rent. How much is it? That amount. Do you understand me? Now, because I'm using Excel, I can now use the formulas, but you must calculate the second year, you calculate the third year, you calculate the fourth year until the fifth year. Now, closing balance in year 1 becomes the opening balance in year 2. Are we together? So what is the opening balance in year 2? That. Okay. Now, what is finance charge? It is a percentage. Do we agree? So 10% of 278. What is the outstanding balance? Do you see what I'm doing? Outstanding balance is plus that. Rent does not change. Rent remains the same every year. Do we agree?
Yes.
Okay. I know how to use shortcuts in formulas, but I'm not just using, so that I just go slowly there. Now, rent remains what? The same per year.
Same.
Now, what is the closing balance? Do you understand?
Outstanding.
Now, what is the opening balance in the third year? You now know the trend. Do you agree?
Yes.
The next one
Yes, we do.
is this one here, but we have still not calculated it. The next one is that there. Do you agree with me? So I'll just scroll this down.
You scrolled.
I'll also scroll that. Okay, but why is it different? Because I've still not got this. Are you seeing I have all my workings? It is very easy because I'm using Excel, but you must do one by one. So opening balance is the cost of the asset. Finance charge is a percentage of that. So 10% of what? Of opening. Do you agree? 10% of? Have you understood everything there? Now, what goes to the income statement? etc. Now, what I'll do next is to show what goes to the income statement, balance sheet, etc. Now, let me start with income statement. I'll have year 1, year 2, year 3, year 4, and year 5. Now, what goes to the income statement? First of all, everything here is an expense. It will be an expense. And which expense do we have? The first expense is depreciation.
Finance lease.
Depreciation is the first. Don't forget about depreciation. And then the second one is finance charge. Are we together?
Yes.
Now, what is the depreciation? Depreciation was working 2. Do you see working 2? So I'll just write into bracket working 2. And then I'll just pick the answers of working 2. So what is depreciation for the first year? It is this. Do you see that?
Yes.
So for the second year is also the same. For the For the
The
third
same
year
for 5 years.
is also the same because
The
we are
same.
using straight line depreciation.
Yeah.
Are we together? Finance charge, you pick this column. Do you see this column?
Yes.
For the first year, it is how much? That.
3200.
Second year, 20?
27.
Third year, 20?
22.
Fourth year,
17.
17. And fifth year, 11.
11.
Now, income statement has no problem. Income statement is very good. Where we always have many questions is, okay, has everyone understood income statement?
Yes.
So, number one, when accounting for lease, number one, you calculate depreciation. Number two, you calculate what? Finance charge. Any question before I move to balance sheet?
This is
Now,
for Deresa.
yes?
This is for Deresa.
This is for the leasee. This is in the books of leasee. Leasee is the business. In the books of who? The leasee. Thank you for the question. The business is always the leasee. The person leasing, not the person giving out, the person receiving, the person renting. Are we together? Okay.
Yes.
Now, this is an asset that was being leased. Now, again, I will show my years. Year one, year one, year two like that, year three, year four, year five. Now, the person leasing also accounts for the asset. So I'll start by showing my non-current assets. Now, in non-current assets, we always get the cost of the asset. What do you always less? What do you always less? Less accumulated depreciation to give you what is called net
book value.
Net book value.
Are we together? Now,
Yes.
you also go to liabilities. You also show liabilities. Let me see the space I'm remaining with. So I can just write here, liabilities. Now, liabilities, here let us be very attentive. There are two liabilities. There is non-current
and current
liabilities. What is a non-current liabilities? A liability that takes more than 1 year to pay. Do you agree?
Yeah.
And then we have current
liability.
Current liabilities. Now you call these lease obligations. Obligated to pay. This one will also be what? Lease obligation. Now, you appreciate why it is very important to do standards before company accounts. Because if there is an additional information on leases, your balance sheet will not balance without accounting for leases. You get me? So, which means there will be an non-current liability called what? Yes. Lease obligation. There will be a current liability called what? Lease obligation. When there is what? When there is information on leases. Now, what is the cost of the asset? I've really shouted. What is the cost of the asset?
32.
324.
320? I can use that. Yeah? So the cost was 324. Does the cost of the asset change? No.
No.
What is happening here?
I don't know.
Okay. I've understood. Now, okay, I've understood. I cannot scroll. What will I do? I'll just transfer.
Transfer.
Okay. I'll just transfer. Now, have we understood the cost of the asset? The cost is given.
Yes.
Depreciation. What is depreciation the first year?
64.
800.
Are we together? What is depreciation? What is depreciation in the second year? Accumulated. It is depreciation in the first year
The first plus the
plus
second.
depreciation in the second year. Do you agree?
Yes.
What is depreciation in the third year? Depreciation in the first year plus depreciation in the second year plus depreciation in the third year. That is accumulated depreciation. What is depreciation in the fourth year? Accumulated depreciation first year plus second year plus third year plus fourth year. Are we together? What is the fifth one?
The same.
Same concept. Plus second plus third plus fourth plus fifth. Are we together? What is net book value? Net book value is cost minus accumulated depreciation. Do you agree with me?
Yeah.
Okay, so I have that. So here I can get those values. Value, I can also get those values. Now, here, let us be very attentive. Let us be very attentive. What I'm interested in is that column. This column normally goes to the income statement. Are we together? The last column goes to the balance sheet. What goes to the balance sheet? The last column. Please understand me very well. Okay. There are people who have raised their hands. Samson and Laurian. You know, I'm using the phone, your phone. Do you have a question? Can we continue? Because time is almost. We are remaining with 20 minutes. Can we continue?
Yes.
We are only remaining with 20 minutes, please. Now, please understand me. Here, what are non-current liabilities? Somebody tell me. What are non-current liabilities? Liabilities.
For more than 1 year.
Thank you. Now, can we all meet together? Okay, I've just muted everyone so that I concentrate in my last minutes. Now, what we have said, this is what goes to the balance sheet. First year, this is the obligation, the total obligation. How much is it? 278. Do you see 278? Now, yes. 278 in the second year, how much is remaining?
228.
What does that tell you? Between first year and second year, there is an amount that was paid. Do you see that? Between year 1 and year 2, the obligation has reduced. Do you see it has reduced? From 278, yes. It has reduced to 228. Do you understand me? So that reduction is the obligation that is a current liability. So what is the current liability? It is the difference between this and the next one. So what is your current liability? The difference between year 1 and year 2. What is the current liability in year 2? Somebody to help me. The difference between year 2 and year 3. What is the current liability in year 3? The difference between year 3 and year 4. What is the current liability in year 4? The difference between
year 4 and year 5.
Are we together? Now, in year 5, please let us be together here. The whole amount is a current liability because it must be paid then. Now, look at what I'm doing. Now, in this total liability of 278, 49 is current. The difference is non-current. Now, instead of getting the difference, you just pick the next, the next, the next, the next. Those are the non-currents. Now, see what I'm doing? What is the non-current in year 1? We pick the next one of year 2. What is 22. The non-current in year 2? It is the amount for year 3. What is the non-current in year 3? The amount for year 4. What is the non-current in year 4? It is the amount for year 5. Why are we not having something there? Somebody to answer me. Why is this figure missing? Why is it missing?
Because the rest obligation is in current liability.
Thank you. It is for only 1 year. So non-current ends here, the 2 years there. In the last year, everything is current. Thank you. What is the current? So let's pick the current that we have calculated, the difference. The next one is that. The next one, 60. The next one,
66.
66. I've made a mistake somewhere.
I don't know. Yeah.
Do we have a figure here? Yes. What is the figure here? It is the 47.
That one. Yes.
Do you agree? Because in the 5th year, the whole amount is a current liability. Now, how much is it? In the 5th year,
47.
it is 47. Are we together? Now, when you add non-current plus current, what will be the total liability? Total liability. What will be the total liability? You will add non-current plus current. Are we together? These 278 must be equal to that. That is why I was saying this 278 has got both current and non-current in it. So
Yes.
the next one is, I'll just scroll. So the next one is 228. It is that 228. The next one is 174. It is that. Do you understand me? Until the end. That is how to account for arrears. Any question? This is what goes, but what was the question? Remember, the question was asking you, let's not forget the question. The question was asking you, show the extract of statement of profit and loss and statement of what? For which year? Year ended 31st March 2013 and 2014. 2013 is how many years? How many years from the lease?
2 years.
And
2 years.
2014 is? So what you are being asked, understand me, what you are being asked is that. Those figures. Have you understood me?
Yes.
You are being asked, so we are not interested in these ones. What you are being asked was for year 2 and year 3. That is using which method? That is using advance. Sorry, arrears. Arrears. What about advance? In the last 10 minutes, allow me just to, it's the same concept, but we are just rearranging. So allow me in the last 10 minutes to do advance, and then we end the class. Are we together?
Yes.
So here, let me add rows, sorry. Let me add more rows so that our years. So we have year 1, year 2, year 3, year 4, and year 5. What is opening balance? We said opening balance is normally the cost.
Yes.
Opening balance is the cost. Rent. How much rent were we paying? Rent we were paying 77. So I can just pick the others so that we save time. Are we together?
Yes.
Yes.
Okay, let us continue. Now, what is outstanding? Rent. What did we do to rent? to get here, what were we doing to rent? Rent was being deducted.
Well,
Do you see that?
yes.
So always deduct rent. So outstanding balance here will be opening minus rent.
Right.
Are we together? Opening plus, so sorry, opening minus rent.
Rent.
So whatever it gives you. Now,
Rent.
finance charge. What is finance charge? It is now 10% of outstanding. What is next to it? So 10%, somebody to give me, it is this times 10%, whatever amount you get. What is closing? Closing here, it is this plus finance charge is added, rent is subtracted. I'm repeating, finance charge is
Added.
finance charge is added, rent is subtracted. Now, let me round off these figures so that we don't have problems of rounding off. Now, can you help me here? What is the opening balance in year 2? It is the
27.
Okay, so I can scroll these down. I can also scroll these down. I can also scroll these down so that we just have calculation. So what will be this? It will be the amount in that year. What will be the next one here? It will be the amount in that year. What will be the last one there? It will be the amount in that year. Are we together?
Yes.
Now, please, the accounting treatment is the same. This finance charge, what will be the extracts? Again, I'll put year 1, year 2, year 3. Year.
Lecturer, look on the 5th year. Is it correct? The minus 1? Yes. Minus 1 in the outstanding balance.
It is just rounding off.
It is correct.
It is correct. It's just a rounding off.
Yes.
That is why we got a minus.
Okay.
Together?
Yes.
Okay. So let's continue. It is correct. So what I was saying, what is our extract? What is our expense? We've all agreed there are 2 expenses. Depreciation. And
the finance.
Finance charge. Okay. Depreciation and finance charge. What is depreciation?
Depreciation was
I can just speak it the way it was. Are you seeing depreciation?
Yes.
So let me pick it to save time. So depreciation is that. What has it done?
I don't know.
Transfer it.
That was the formula.
There is a formula.
Value.
Yes,
Use the value.
What did I do?
I paste values.
The paste values.
Okay.
Values.
So, which paste option will I use?
Value. Value.
Value.
Okay, thank you.
Okay.
Thank you. What is finance charge? Somebody to help me. Finance charge is there. Do you see this?
Yes.
So it is that. The next one is that. We continue like that until the end. Do you understand me?
Yes.
Yes.
That and
there is no charges.
There is no charge. It is zero. Now, that is expense. Extract of statement of financial position. I think all of us can do that, yeah? This, look at this. Let me copy.
And then multiply.
Which one? Which should I paste?
Values.
Values.
There's one.
Now, here, this remains the same. But here, let me use formula. so that when you are revising, you know.
Yeah.
Are we together?
Yes. Yes.
Okay, so I've used a formula there. Now, these ones will change. Do you agree these ones will change?
Yeah, yeah, yeah.
They will change based on, I'm just finishing. You know, I don't like taking people's time. When we agree, I just try to respect time. So I'm just trying to, now, if there is somebody who understood me, help me. What will be there? The lease obligation in year one. Non-current. It will be the one of the second year. Are we together? This one will be the one of the
Third year.
third year. This one will be for the amount of the fourth year. This one will be for the amount of the fifth year, but even if you don't put it, we don't care because it was supposed to be actually 0. Now, what will be this? Somebody to help me. What will be this? It will be that minus that. Do you agree?
Yes.
The next one will be
Year
year 2 minus year.
three.
The next one will be year 3 minus year 4. The last one will be year
It will be 0.
0. Now, that is it. You were asked for which year? Year 2 and year 3. Now, my question is, are you in a position to practice many more questions? When practicing, know how to account for advance and know how to account for arrears. Are we together?
Yes.
Now, my next class for Kigali campus is on Saturday. Do we agree? Now, Saturday, I will only take 5 minutes to explain what is called sale and leaseback, to just explain, and then we start consolidation. Are we together?
Yes.
Now, all the remaining standards will be covered on Wednesday. You understand what I mean by that? All the remaining standards will be covered on Wednesdays. Every Wednesday, we'll be meeting to cover a standard. Are we together?
Yes.
Maybe next Wednesday, we will cover maybe IAS 20. The Wednesday that follows, IAS 12, income tax, deferred and current tax. Maybe the one that follows, financial instruments, until we finish. Do we agree?
Yes.
Yeah. So on Saturday, for Kigali, Msanze, we are not meeting. We are not meeting on Saturday. Follow your timetable. But every Wednesday, I'm combining both Kigali and Msanze in order to cover standards. Are we together?
Yes.
So let us meet on Saturday for Kigali and all of us on Wednesday next week for both Kigali and Msanze. The numbers were high because I combined Msanze and Kigali. Don't worry why we had 120 something. There are 40 students from Msanze. There are around 80 students from Kigali. I hope we are together.
Yes.
Let us have a good night. I'm sharing this Excel. Now in this Excel, there is example 1. Are you seeing this example 1? It is from your notes. Example 2 is also from your notes. Now, we have not done June 2016. Attempt it. I'll put for you there to attempt. Are we together?
Yes.
We have not attempted June 2017. Attempt it. Which question? We attempted June 2017. Now, please, I advise you, Kigali campus, keep time on Saturday. Consolidation is 30 marks in exams. I'm repeating. Consolidation is how many marks? 30.
31 marks.
If you miss consolidation, it is as good as failing. 30 marks. Let us keep time. Let us have a good night. Before you leave, type your name and phone number in the chat so that I can take attendance, especially for Minicofin sponsored, but also for others. Type your name and phone number before you leave in the chat. Always make that a routine. Whether I say or I don't say, always type your name and phone number. Thank you. Have a good night as you type.
Thank you. Good night, sir.
Thank you very much. Good night.
I hope we have understood this. Have you understood?
Yes.
Yes, sir.
At this time on Saturday.
See you on Saturday, Kigali. See you on Wednesday, Msanze. Kigali on Saturday, Msanze.
At what time, Chigari?
Yes?
At what Saturday?
Check the timetable. I don't have it. Somebody to remind us what time? What time is the Saturday class? 8.
8 sharp.
8 in the morning. 8 sharp in the morning.
Yeah.
Thank you.
Have a good night. You see, financial reporting is very enjoyable if you follow. So please follow all classes. Financial reporting will be the easiest subject if you follow all classes. Thank you. Good night.
Thank you very much.
Good night.
We are waiting here the sheet.
I'm sending it in the next 30 minutes because I'm saving the class. I'm recording the class. Once I record the class and it finishes, I will just send you in the WhatsApp group. Is that okay? For both Kigali
Yes.
and Msanze?
Thank you, sir.
Okay.
Okay, thank you.
Thanks.
No.
Thank you, sir.
I'm waiting for you to chat your names.
Ab'i Kigali.
Is telling me you need PowerPoint. You don't need PowerPoint because they are extracts from your notes. They are just extracts from your notes.
Enzo.